So as always, we start with a disclaimer. This is not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or financial investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Wong and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. This conversation will be recorded and posted for future reference. So it seems like we don't have that many people today, so I'll just get going anyway. Marcus or Tim, since you're the only people in the room, you're welcome to raise your hand and be invited to the stage. Again, this was the highlighted, post from Twitter, and I do think crypto is an interesting market. It has a lot of the characteristics that we like as systematic traders, but also as trend followers or whatever strategy you're doing, because of the let's say emerging market characteristics. This does provide a different quality to the types of strategies that you can run, and so I think we can go through that a bit. My experience with crypto, I guess we can start there to just kind of like lay some groundwork. I have been involved in mining before. I am involved in the crypto digital assets part of the market professionally, so feel free to ask me. But I think that now it has reached the mainstream, and it is basically just laying out there beyond tech stocks on the risk curve. Before it really hadn't been part of the vernacular, hadn't been part of the efficient frontier of portfolio optimization or portfolio asset selection, but now it definitely is. And by thinking about it that way, that also means the market is maturing, and that maturation process is what some people believe is disrupting this 4-year process of the halvening cycle in Bitcoin, and why certain macro elements have begun to creep their way in to affecting the markets when it used to be much more decorrelated with traditional markets, but is now becoming much more correlated. And this is where people are saying that, okay, now it's just a high beta tech stock, things like that. I'm happy to answer questions, or just open it up. Of course, raise your hand and we can all have a discussion here.
Hello, everyone. So what I can say about crypto from my side is that I started trading it in 2017, somewhere in the middle of the year when Bitcoin was at 2K USD. And at that time, it was basically just a hype. Retail traders, investors were getting involved, not so much about institutions. And I didn't have any specific method myself then. I admit I just bought it out of FOMO and traded it very conservatively. Today I trade only Bitcoin with my long-term trend following approach. I just want to see higher highs, higher lows to keep me invested. And when I see that lower high, lower low, I take risk off. So that's, in short, basically what I do in crypto. But my position size relatively to my overall portfolio is very small, because I mostly trade the US stocks.
Thanks, Marcus. Hi, everyone. Hi, Derek. Look, I'm here once again, probably just to listen, because I'm certainly not an expert in crypto, but I do trade it in relation to just another trend-following data stream. But I suppose I'm sort of interested in how, as a new technology, all of these cryptocurrencies are sort of adopted a similar growth spurt that we saw with the tech explosion in the 2000s. So I suppose there's inevitably a lot of fallout that's going to occur with the different providers, but there's certainly some functions in crypto that I think are very powerful. I'm sure it is going to blossom in the long term, but whether it's going to be in the current sort of nature that we see it now, I just don't know. But I'm certainly not an expert here, so I'm mostly here to listen. But thanks for inviting me along.
Yeah, I see a lot of people draw parallels to the dot coms with crypto. And, I was also involved previously, around the time Marcus said 2016, 2017, and that run up. And, I felt that that time was probably more aligned with the dot com era because of the ICOs boom, where you had a lot of people just saying, okay, this is crypto. I can raise tens of millions, hundreds of millions of dollars. It was very similar to, going IPO in the dot com era. And then we were, having a lot of the fallout there. I don't think that we can pick the winners, as it would be very hard pressed to say that Yahoo would be, was going to be a loser in the long run when Google took over, when they were, really big back then, or Alta Vista, Pets.com, things like that. So my kind of just putting us where we are in the phase of maturity, and this is my opinion only, is we're beyond that. We're kind of at the next part where we did see, 80% drawdowns in Amazon. There already has been creative destruction in the previous crypto winter. The projects that are coming out now have much better white papers. People are more scrutinous on the teams. We need to know, who's your background, things like that. Do you have relevant experience in the area? And the VCs have gotten a lot smarter as well. They're able to create communities around these products, and I think that is really what's being monetized, giving users some of the value of the network as well as the provider, and that sharing rather than what we have now, where Google and Facebook own the network, and you, the product, you are the person, the user of the product, get none of that value. And you know I am not a fundamental guy. I, obviously with Quant Brainstorm to determine who's going to be the winner, but it is definitely going to have some creative destruction if maybe this time now is going to be another crypto winter, because that's how all tech goes. It's launch, iterate, launch, iterate, and the whole step up function of this thing, where we improve our ability to deal with the technology, increase the regulation, increase transparency, increase our own understanding of the new techs that are coming out, which ones are just copies, which ones are actually providing value. And you know the traditional finance world, which has been attacked by DeFi, as well as other, more physical things. You could think of those like real estate or warrants or commercial buildings or things, will get the use cases that they have right now that will increase the efficiency. Again, that's a non-quantitative view of the kind of thing, but just kind of my experience so far.
Yeah, that's very interesting, Derek. As I said, I'm certainly no expert, but you certainly put it into perspective there. In relation to the functional elements of crypto, that's sort of exciting to me, like the different roles that Ethereum play to, say, Bitcoin. Um, you know, there's a lot of functionality in Ethereum models, all of that sort of thing. How do you view that's all going to fall out? Like, there clearly is value in the usage. How do you think that's going to resolve itself?
I think that right now, kind of the positioning of Bitcoin is gold, or the digital gold, or rather like the dollar settlement system. You have the thing that will store value closest to what you expect to get. It's got the lowest volatility. It's got the good market cap. It's something you, as in the crypto universe, feel safe. Less stable coins, and Ethereum seems to be like a Swift, a settlement layer. You could think of it as like a BIS. They are the thing that money, value, smart contracts will be transmitted through, and then building on top of them. So it's like that kind of network effect. I think eventually we'll probably stop interacting with Ethereum itself and start interacting with the apps on top of it. And DeFi is a great example of that. How this whole thing shakes out, which providers, I don't think either one of those two is going to die. But then you've got the Solana, Avalanche, Luna kind of areas, and that is there's the trilemma. So you can only like have speed, security, and decentralization. They've chosen two other aspects to focus on, and I do think that's part of the use case. Some people will give up decentralization for speed and cheapness. That is a use case for that, and we have the kind of like religiosity, the zealotism of like, no, we need ultimate decentralization and things, and to be censorship resistant, that is part of it, but that doesn't mean these other things can't find a home. Who will be the dominant? There'll probably be 3 or to 5 major companies or major coins in each of these different use cases, just like we have in the normal world. No one blinks an eye, that we have Sony, Panasonic, and all these other TV makers, or your computers, or whatever. Normally, there will be a group of winners, and then the rest will either be acquired for their technology, and we'll get some consolidation. But I do believe we need a creative destruction of a crypto winter to do that, because that's when most of the building gets done. If we look at the last crypto winter from 2018, 2019, that's where a lot of these projects got started. People were able to put their head down. They were able to get out of the psychology of this retail driven market, and actually just like, what, we've got enough, we've got a good idea, we've made a bit, and got enough in the coffers to try to deliver real product. And I think that's how it's going to work. Don't ask me how to pick a winner, because I don't know how to do that. I'm not a tech VC.
No, thanks very much for that.
Have you got any views on Bitcoin or crypto yield curves and the ability to effectively assess the value of this thing through time? At the moment, there's various things, but it doesn't feel like we got a real yield curve, and it feels like all these opportunities for staking and APYs, APRs, however yields that get that are being paid are more a function of volatility than actual time value of crypto. So yeah, do you have any views? Do you have any, I don't know, intelligence, anything that any comments that you can add, and as in a way of creating this thing and how to trade it? Because to me, this is real. This is a real question.
No, I think you're on the right path. And what you said about the yield curve / time value of crypto versus the vol curve, I feel like the vol curve is more developed than the forward curve of crypto because of the participants, right? If we think about how emerging markets evolve over time, most of them will start as retail driven, and China has gone through that with their multiple crashes. Say I think they had 2016 around, and then they flushed out a lot of the highly leveraged retail traders, and then it never really recovered. But because they added more regulation and things like that, we've seen it in Korea. I'm giving Asian examples because that's what I'm most familiar with. But every country goes through that, and the issue is still now in crypto. There is still a large proportion of hodlers, people who are not moving their coins from their wallet, and there's also still a large proportion of retail. And retail doesn't have necessarily a need for long-term time value of money. You need traditional asset people who want to hedge something long-term in the 10-20 year space to get information from that. I do think the ability to generate yield, especially like forward yield, is going to have an effect on what is like the implied yield of Bitcoin. DeFi really helped that and did push out some more information onto the time value of money yield curve, so like the rates yield curve. But I feel that there's more information on the vol surface, because you have a lot more professionals trading long-term vol, and these market makers are from the traditional markets, and they are going to delever, and you have very much Wall Street bets like retailers playing in the front end. So it's like, why am I going to, buy the December quarterly future if I can just buy the spot and I've got this like negative roll down thing? As a retailer, it's smarter and easier, and I don't have to understand this. Um, Trading the futures basis was a huge play pre-COVID, and that has been squashed down. A lot of the easy curve trading has gone, although it does spike up. But again, it's a negative skew trade, so like you need to wait for it to spike up and go down. I do think, again, because there's not so many houses taking on all the risk at all points because of some maybe liquidity constraints. You have a very fragmented market. It's not like we can just go to CME and everyone is pointing at one curve. You've got dozens and dozens of derivatives exchanges, all with their own contracts, all with all different contract specs. Some with giving you basically a quanto because they're paying you out in that same coin, or they're paying you out in a stable coin, which was a great innovation that really helped a lot because that took out one part of the risk that you had to hedge out if you're trying to do this thing. So I mean, this part is still, how do you say, developing. Information as strong as we invert the yield curve of the U.S. Treasury yield curve and say that a recession is coming, Harvey Bassman style. I don't think we're there yet, but that also means that there's more noise in it. So if you are able to take pairs trades or manage yourself well, the opportunities are still there. It's a bit more squished, which again goes to the maturing market. But I wouldn't say there's no opportunities yet, or I don't know how to phrase that.
No, thanks. I agree with everything you said. My question is more on the side of it's difficult. I find difficult to trade, these either vol or yield curve, positions in Bitcoin away from DeFi, for lack of better words, or channels that are closed and boxed up channels. So it's brokers in the future space think in terms of collateral as cash. Bitcoin really doesn't, really, Bitcoin exchanges and wallets and only are set up to hold crypto. So it's difficult to find fungibility away from, as I said, proprietary channels. At least that's been my experience. Am I missing something, or this is really the next revolution that we're all waiting for?
No, you're bang on. The idea that crypto exchanges, especially like unregulated ones, use over collateralization of the margin, and DeFi protocols as well, is one of the largest problems with crypto at the moment. And the reason why is, especially with these smart contracts, you have no other way to get recourse. If you have recourse, then you can use cash as collateralization that's from another bank or another partner. But if you are in this kind of world where I can just send you money and I don't really know who you are and I can't track you down and I don't have a legally binding agreement like an ISDA or something like that to come after you, then that part of the functionality cannot exist. I do think it is going to be the next big boom. It will increase the amount of leverage that we will have in the system. And people are always saying like, oh, you can go 100x on crypto or whatever. But actually, I think because of this fungibility that you have in the traditional financial system and not having over collateralization, I actually would say that probably structured products and crazy options and things like that, I have much more realized leverage than people with large crypto positions on exchanges, because once you get big enough on these things, your margin does not increase linearly, it increases exponentially. So it gets really hard to post, margin for large positions because it just consumes so much of your capital. And so again, that decreases the efficiency of the markets. That decreases the ability for people to remove arbs or to remove aspects of the curve because they can't easily put things on in large enough size in one go because of the lack of fungibility, and it also decreases the speed at which these things revert because you need to migrate around, or you need to push it, like the thing only exists on one exchange, so now I have a capacity constraint. All of these things are opportunities for now, but they don't make for an efficient market. So it kind of depends on your approach. Like, do you like it better when it's not efficient, not it has all these issues, or would you prefer that it is more efficient and you are able to get more leverage and you need to maximize those returns? Because in the end, if the opportunity is larger and you can do it with less leverage, maybe they're net the same proportion of returns. I'm not sure.
Well, this is the question. And again, without going back into negative skew versus positive skew, but you said it. I mean, you're forced to use a proprietary channel. So you're at the behest of your intermediary. And if they want to shut you off, I mean, it doesn't matter if the opportunity is to make 100x, in a month. But, if you can only execute a tenth of that, that 100x becomes an optical illusion. And that was the point that I'm trying to, assess. I mean, am I really behind, or is really the market like this?
I'm assuming it's still a very fragmented market, and I'm assuming that what we're experiencing at the moment is effectively like a battle for the platforms. But ultimately, there'll need to be a time where these different crypto products need to consolidate and act as a store of value and act as a functional platform with smart contracts. So they need to start collaborating together as opposed to trying to sort of promote themselves as distinct product. But I assume that naturally through competition and evolution, we're going to ultimately get that, where we get this alternative universe that basically replaces the traditional architecture that we see in the conventional economy. I'm assuming that's the case. Am I wrong there?
I think I'll answer both questions. I'll start with Rich's. I do think there will be some kind of consolidation. I don't think everything needs to fit into a box that we understand now, because if Web3 is real, we will have products we've never seen before that we cannot put into a traditional box. Just like no one thought, what is social media? Everyone should, meet face to face, go to the pub. That was a mind, opener that could never have been classified in the Web 1 world. I believe those types of products will exist. Going to Bruno's point, is it an illusion? I mean, right now the markets are pretty efficient. There's a lot of big guys out there, and multiple of them with multiple proprietary connections that are able to arb this thing pretty fast. Are you able to detect lead lags? Are you able to look into the, memory of the upcoming blocks that are potential transactions? Yeah, sure, you can do that. Miners do that all the time to do selective, moving and things like that. Sure, there are these time arbitrage type things. But again, what we have now and what we have in 2017 is totally different. You won't see those 100x type, arbs anymore, I don't think. That's how really a lot of these guys like, SBF and what is it, Arthur Hayes at BitMEX got their start. A lot of people were able to get those juicy things, and now that doesn't exist. But that also means the markets are efficient enough. If you are getting a bad price, or like you're pushing the price up, someone is going to push it down into you because they have a leg off. And maybe it just takes 10 of these people, or maybe these people have 10 accounts and it's one guy. Yeah, okay, you have counterparty risk, but everyone's spreading their risk around to different counterparties. So yes, you do need the ability to communicate with multiple exchanges, which we take for granted, as all of us, probably use some broker's platform to trade U.S. equities. But really, there's just so many exchanges, right? You have the Philadelphia Exchange, the American Stock Exchange, NASDAQ, NYSE. It's just hidden behind this, interactive brokers or Ameritrade or whatever broker you're using. And it's taken for granted. Now, if you build that and you have that network to attach to those things, it's still worth something.
It reminds me a photo someone shared recently on Twitter where it showed the top 20 coins, cryptos in 2017, and top 20 cryptos currently. And though the top 2, Bitcoin and Ethereum, have held their spot, the others had been replaced in a large way. So there were many new cryptos in top 10 and top 20, and the ones were there 5 years ago. I don't know if they're like gone or pushed down, but I think yeah, we'll see in the next 5 years if these that have come up to the top now will have any real function or value, or we can see like in 5 years again new cryptos in the top.
I'm actually going to call out to Artur Sepp because he's quite knowledgeable in crypto and quantitative strategies. You know, maybe he can come up and talk about what he sees in the quantitative space of crypto.
Hi everyone. Thank you, Derek. Recently I have been following some of the charts, but didn't have chance to join. So today, yes, I appreciate your comments and ideas on crypto. So well I joined. I mean, I work in this space professionally now. I joined Signum last October, and we are developing the whole suite of investment products. So starting from say sectors, building some capability to do sector-based selection, also to say systematic, like versions of say trend following or momentum strategies, and also to crypto options. So it's my first. I tell you this, it's very exciting because everything needs to be started from scratch, and also the traditional way you think of asset classes is very different. I think talking as a say systematic, say quant, systematic portfolio manager. The first challenge is, of course, data. It's very different from different market providers. You get from different data for what you think should be one estimate. And one example is market cap. Of course, for major protocols, you know exactly, right? It's pretty much fixed. But for some smaller ones, even say in DeFi space, Uniswap, example, they have different. Say some of the Uniswap tokens are held in treasury, some were distributed to investors, but out of investors, some can be like hodlers, right? So it's not always clear. You have different definitions of market caps. Say active supply, realized cap, which is and even say challenge even building a weighted market cap weighted index is difficult. Stuff what someone mentioned, of course you have enormous idiosyncratic risk, right? And if you want to invest, say in Web3 or metaverse, right, you can, okay, you can do your say selection. You have to read the white papers exactly to say how to target this, like how to classify different protocols into tokens. And of course, then you, like my opinion, you cannot do it just like stock picking will not work because amount of uncertainty, both on the protocol level, on the business upside, it's enormously will be. It's impossible to. You have to be very lucky. Of course, someone will make a good selection, but in general, this should be say systematic way. In systematic ways, of course, you build up some tracker, right? You track coins in the universe, and so we currently actually developing sector indices like for different say trends. So we have DeFi, Web3, say Web3 layer one, Web3 infra. So I think for because it's for institutional investors, it's the best way to say to invest, the best way to approach the market. And on the other hand, so we also what currently right now we trying to make say how you sell it, right? So what is a say of course we may have personal views on this and personal investment, but if we want to say I'm trying to make crypto, and Derek did very well. In the end, you invest in technology. It's one of the way to invest in technology, and some of the technology it will be either some of the protocols they will be able to develop on themselves and then generate some say revenue on their activities, and some kind of distributed through the tokens, through native tokens. So some will be acquired, right? And but the way we want to position it as an asset class is really more alternatives, right? So we also I'm writing a paper just to think about say what I can bring, what crypto can bring, and I think it's really more say equity like sort of private type investments, which of course where say advantage of doing this through say institutional, through institutional fund managers is of course we take care of due diligence of classical say of all management of products, data management, liquidity management, and maybe finally what interesting remark is trend following. So of course as you probably I mean it's probably the first thing if you want to create something say systematic, but not really like say sometimes people just ask you for beta exposure, then you go with a sector, so market cap weighted, or then of course on systematic side trend following, right? So answer it works. It's although one of restriction you cannot short, right? For different reasons. It's not maybe say for past 1 or 2 years you could short still. Your shorting would be restricted to probably Bitcoin, Ethereum, but it's very say the challenge here is that it's very volatile market, and volatile in a sense that it's very difficult to capture momentum through say traditional trend following. So long short short is very hard to make money on short side. On long side it's okay. And also people, as Derek said, fundamentally people are thinking more like in terms of loan only exposure, right? It's the sector holders, people don't understand, or they don't find it reasonable. How would you short crypto as an asset class? So we have also in our pipeline is what we call tactical allocation model, which can only be loan, right? Actually, I would say it's more drawdown management tool, say, or like product with alternative way also to manage your drawdowns, which is now it's of course flat. It's actually it does what it's supposed to do. So well, yes. So that's that, and of course, crypto options, very exciting. It's actually it's very exciting because volatilities are very high, realized volatilities. So we are talking like Bitcoin is around 60, 70. Ethereum is around 90 now, but they can be up to say 200-300 in a short period of time. Implied volatilities also, they have particular view that usually so positively skewed. So meaning that people usually if they buy options, they buy calls, out of the money calls. So and it's flow driven. So there was during the I think October, November when ETFs, Bitcoin ETF was approved. It was like it was followed by a rally, and we saw very big spike in out of the money calls. So like for example, March 2022, 400k call was quite sizable premium, almost 1% premium. Implied vol was I think 130% for that particular strike. So. So it's another way also probably for speculation. And recently also what's happening, so it has positive, like it has changes, say skewness, option skewness. And also during this year, actually the first 2 weeks, we saw very interesting dynamics. When the spot went down, right, it started to correct, but actually implied volatility also went down. So 1 week ago, before the kind of big or 2 weeks ago, before the big correction, you could actually at the money puts on Bitcoin was at 50% vol. So imagine now you realize it's close to 100%. So it's really, so now it's kind of flipped. So whenever things become terrible, right, you implied vol jumped, and now you have a bit of reversion. So to conclude, sorry guys, I took so long time. It's an interesting market. It's a lot of activities that say a lot of interesting things that you can bring from traditional markets, and a lot of things that you have to adjust and to tweak your understanding, your models into reality of crypto. Yeah. Thank you.
Thank you, Arthur. That was amazing. I have a very long list of notes on that because a lot of what you said resonated with me. And the first thing was that you're giving equity-like exposure but a private exposure, and I think that that's right. This is the first time we have basically a liquid private equity investment. You're able to get in relatively early, before like pre-IPO stage of these technologies. Okay, you will be behind a few people who get private deals, but it's also like highly liquid, right? And so you don't have that type of risk that you had before. I mean, people assume that the high sharpened PE is because, you know, that's like it's different, it will diversify. No, it's just because it's the illiquidity premium. That aside, another thing that you mentioned was the sectors, and the sectorization is something that I also have been thinking about. You can do it fundamentally by trying to group together different types of technologies by reading the white papers. But if I did a cluster analysis on this, coming from a purely statistical standpoint, I get totally different groupings. And even if you look at the lead lag reactions happening between different coins, they don't necessarily line up with what I would think is fundamental. So I find that to be very confusing. Again, it goes back to what you said. These things are flow driven. So the power of the meme and the power of sentiment to break down these fundamental relationships that you would expect to occur and what actually occurs in price is totally different. And I have more to say, but I'll stop there.
Thank you, Derek. Yes, for me it was difficult to stop. As I said, it's a very exciting topic. And as you said, also, I agree. It's like one thing, for example, when, you read these white papers, they always say that it's unique. It's very difficult to read and to assign really like what it should be. Say it's a blockchain or it's a DeFi or it's a combination in between, especially for smaller ones. I think, yeah, I would maybe try to also address natural language process. Just, I think in quantitative firms, in long short equity in particular, people use some sort of NLP uh, trained on. You don't even need to train. You just try to gauge the similarity of, say, different quarterly reports or say company, no, not prospectus, but annual reports to build some sort of sector based. With statistical clustering, always it's sensitive to sample p. It's okay probably to use for say systematic strategies where you can control the what is the say speed of your system to a little bit adjust your clustering.
No, I think that's right. Because there's so many coins, this is really where NLP and machine learning will help you because you need to sift through so much information. Even a simple bag of words where you just like label all the things for DeFi, label all the things for store of value, that would be able to sectorize things in a systematic way, and then anything new comes out, you just feed it the white paper. I want to hit on the volatility aspect of what you mentioned before, because I also found the vol dynamics really interesting because it's been really weird in equities. We have this vol up, spot up, but that's pretty normal in crypto, and everyone expects spot down, vol up in equities, and that's not what's really been happening either. So the ability for this to change its skewness of the smile reminds me a lot more of commodities because it can be positively skewed, negatively skewed, and it's mostly flow driven. The idea that we do have the realized is very high, but also the implieds are really high, and you have this kind of spread, and this interesting dynamic of where things can be underpriced because you have a lot of retail flow. I do think is a large opportunity, but I think it's also I don't know, maybe it's out of my bounds, but it's harder to execute in size because of capacity constraints. But I would ask you, how do you think about implementing these things for the institutional size? I mean, for now, really, we only have what Durabit, maybe OKX, some things like that, and some OTC. Are you able to still get those juicy spreads with OTC options?
Can you repeat your question?
So we have a lot of opportunities in the crypto vol space, but there's a lot of capacity constraint, or at least from what
Yes.
I see on lit market. Are you able to put institutional flow through OTC and still get the high realized implied spread?
Well, yeah, it's a hard question. I can't. So what our idea is first to start with very simple, say, strategies that say either protective or say call overrides. How much is scalable? I mean, Deribit is the biggest one. It's yes, it's OTC, but I think its volumes are probably around 10 billion or something per day. So it's a liquid one, but of course it's not it's not also for say like frequent trading. It's more like maybe you can do some like say weekly, monthly, or like a holding period, right? Weekly, monthly. So yes. with SME, they're not very liquid. So that is no. So the exchange traded option market is limited to CME, and that is very liquid. So it's only all flow must go through Deribit. But in Deribit is quite competitive. There are a few market major ones. I think they're all there. It's quite say competitive for spreads.
Yeah, for me personally, investigating and continuing to develop into the crypto option space is something I mean I have been looking at. I do like that it's quite competitive, but I think what you said is true. You've got to be trading out in the longer time horizons because you're not going to beat, you know, the jumps of this world or the Hudson River tradings or any of these guys that are out there. But it makes it liquid enough that if you have that holding period and you're able to leg in for a few days and hold for a month, it's okay. Um, I really, the options in crypto is still something very new to me, but understanding how different these volatility dynamics are and actually seeing how these IV and RV realize and how instant the flow can change, especially at the front end of the curve, I think is really incredible. I mean, if you were able to pick up that 50% vol, option, and then it spiked to 100, and it's really short dated, you've done pretty well, especially on the downside. So, how to identify that, pick that up, and hold the trade for a week or something, I still haven't wrapped my head around fully.
And Arthur, this is perhaps the the point I was trying to get at before. It seems like on the intermediary space. I mean, you guys are one of the good ones. There's a couple of other Swiss competitors of yours, and maybe in Singapore. But it doesn't look like there's a lot of firms that are catering to an investor community that just doesn't want to trade crypto 24/7 on a swap basis and perhaps wants to do a little bit more. I mean, it's difficult to sit down and develop some sort of strategy with financial institutions or quasi-financial institutions dedicated to the crypto space. Is this a regulatory problem? Is it a strategy problem? Why is it so slow going?
Yeah, I think it's a combination of two. So first is regulatory problem, right? And I mean, so even say for you, so in Switzerland, Singapore is quite easier. Say for high net worth, like we're still not getting institutional money even in these jurisdictions. And so to attract the US or UK, ideally you would have something like a managed platform, right? Where you say you as a say okay, it counts as alternative, and then you would have a manager, right? Manage your account, and there are now custody solutions like say Nexco, Galaxy. They have very robust say brokerage platforms. Why it's not yet accepted? I think it's really operational stuff that is not, there's not that sort of easily set up infrastructure, say, to open a managed account for institutionals, right? Exchange traded, of course, it's very limited, and you would not expect this asset class to be for exchange traded on through exchange traded products. Only very simple trackers or very simple baskets. And yes, so mostly I think right now it's really regulatory or operational. That is not yet, say, facilities. There are not yet well developed or well established facilities that we have, say, in managed futures. And the second one I wanted to mention is still its reputation. It's probably when people talk of crypto, say 95% only assume it's a Bitcoin or Ethereum. And in my opinion, it's a limited, it's a core assets within the, say, crypto asset space, but the potential is more, say, doing maybe sector based or some sort of fundamental selection. Yes. So to make it short, it's not yet accepted as an asset class.
And yet you have, specialized institutions like yours, and as you said, a few others in Switzerland and Singapore, but they don't seem to be willing to engage, because I have conversations with a number of those, and they don't seem to be that interested in, developing um, a product to, to extract some of the strategies that you were talking about, for example, IV versus RV, um, in even just Bitcoin, or even the most basic cash and carry arbitrage with futures. I mean, it really is quite strange. It seems like there's on one side you've got institutions trying to capture assets and flows, and on the other side they're sort of slowing down progress. And I don't know, it's a bit weird.
I think that's a interesting comment, though, Bruno. And maybe I flip it on the other side, because there's still a lot of alpha there. And the reason I say that is, if you do have the capability to do this type of thing in a regulated environment and create your own structure, we're not yet at the point where the profits are small enough that you should really be focusing on getting the management fee from the AUM, because you can still extract quite a lot of performance. As the market matures, then you'll start to need to get these, really huge managers to get more AUM under the belt to get the same type of return. And maybe that's just a what is it, like a maturity thing. It will happen, and then it will become more accessible for everyone, but only after the cream has been taken off of the top.
Yeah, no, I agree. I didn't imply that, put me into a fund. I had conversations along the lines of, can you help me, implementing this strategy? And weirdly enough, helping means, can you, handle all the things I need in one place? And the answer was, well, not really, or not yet. And I take your point that there are people who are successful at internalizing everything, but then again, it's a question of how much critical mass and capital you need to do it. And I thought that the sort of creation of these crypto banks or crypto investment firms would allow individual meaning different type of investors, private investors, not necessarily retail, but it would allow to operate as a semi-professional. It doesn't seem to be the case. At least it hasn't been for me. Maybe it's just the case that I don't have enough assets, and that's the answer. But I take your point, Eric.
This.
Yeah.
Go ahead, Marcus.
I wanted to ask if you guys pay attention to the correlation inside the crypto market between the cryptos themselves and the correlation to other asset classes. I mean, for classical trend followers, probably it doesn't matter much, because if they trade 100 markets, it's just another one, even though it's correlated to one or another market. But if I trade US stocks, I have noticed how high the correlation actually has been recently to the S&P 500. If there's a sell-off in equities, there's a sell-off in crypto, and when there's a sell-off in Bitcoin and the larger cryptos, then it's basically all over the crypto market, at least in the top 20 or so. So yeah, what do you think about the correlation to risk assets and cryptos themselves?
I monitor the correlations very carefully. This goes back to this kind of like clustering classification thing that I had mentioned. earlier, because everything is dynamic, everything is flow based. Sentiment can move things around much more so than they can in traditional markets. And especially if you're only trading crypto, you're not really spread across 100 markets. You're trading 100 crypto coins. That's just not 100 markets. That's not really 100 independent bets. You probably have like 3 independent bets or like 5 independent bets or something, but it's like very low. While if you're doing traditional trend following and you have your mix of commodities and all this other kind of stuff, then you probably, with 50 markets, maybe you have, I don't know, 12 or 13 independent bets going. So just because of the diversity of what's the underlying, so you should be paying attention to it. It is implied leverage, whether you believe it or not. And what do I mean by that? If the correlations are high and you put in your different, say 25 basis points into each trade, and they'll start moving together, well, you've just got the sum of all, say, 10 of your trades for 2.5% on one bet. If the correlations decrease, then your implied leverage decreases, and then instead of them being 1, maybe you've got 1% or something, or maybe if it's very, very low, 0.5%. On a single bet, and they're spread out. So because of the very quick natures of this market, and specifically having only a crypto focus, that could be difficult if you are doing it like I think how Jerry does it, where he's just added Bitcoin and Ethereum futures. Then it doesn't really matter so much.
Yeah, this is something I've thought about myself. That I was in terms of 100 markets, I was thinking about traditional trend following, about commodities, bonds, currencies, etc., not just 100 cryptos. But this is one of the reasons why I only trade Bitcoin myself, because I want to have exposure in crypto market, but I'm not specializing in different cryptos and don't want to deal with all that kind of stuff. So I personally think I have enough when I'm just trend following Bitcoin.
I mean, maybe my example was a bit too extreme. I do think that there is diversification in the cryptos, and especially, adding more markets. But it's like adding different equity indices. You will get some diversification benefits for sure. There will be times when some have idiosyncratic risk, like say Europe right now or China before in the Evergrande thing. They will have their own movements. Or would you be disappointed for having 10, equity indice futures in your portfolio? Maybe, I don't know, but 5 is probably good. So I don't see why that analogy wouldn't be the same for crypto. You have a trend following system anyway. You have a stop loss. You have your trailing stop. You have all these things in place. Um, as Richard would say, adding more of them would help you catch more outliers. This is not financial advice.
And the other point is, what
Thanks,
Derek
Derek.
was touching on, the fact, the fact that correlation may or may not be actively monitored and managed. So if you think in terms of portfolios, then yes, you need to be very aware of what is the correlation and keep measuring and testing and make sure that it's always appropriate to what you're trying to do. But if you're doing what Richard and Jerry and the traditional trend follower as well, each crypto is another line item. So I default back to the comment that I made before. There's a subtle difference. I don't know if we spent enough time, talking about the relative importance of correlation in the two paradigms.
Yeah, to me, like in the stock market, the companies are kind of categorized into sectors, and they are real companies earning cash to the shareholders and like cash flow instruments. But and that's a fundamental side, even though I trade fully technically myself. But I kind of like the fundamental idea behind the equities. But I think for me in crypto, it kind of hard to wrap my arms around the fundamentals, if there are much of it or any in most of the coins. So only being technical for me, this is maybe why I trust having more exposure and risk in equities comparing the same amount of risk in cryptos spread across different cryptocurrencies.
I think so over a short term, the correlation is indeed very high. On the other hand, I think it's also a number of discussions that about whether trend following works on like on single stocks. And in my experience, it does not work. And the reason is that there is too much idiosyncratic risk. You have always, even say within the major, say bull market or bear market, you have always earnings reports. You have always these factors, right? That maybe some stocks within, say, they are sensitive to interest rates or some to effects or so saying that you're probably better off by really cluster, like say within equities, you do some sector based, right? You do trend following on sectors, so it gives you depth, right? Of course, you have say recently you have this technology stocks underperformed, some maybe growth or value they outperformed, so you have more say depth of say signals. And in crypto, it's also similar. As I said, probably the best way is to really do indices, right? And you can do different ways. You can do, okay, either just try to match some sort of your idea of based on what the protocol says or statistical. And then based on that, it's actually relatively decadent. Say last year was a good year for everything, but still some crypto sectors performed worse or say not equally well as you think, right? And so something, for example, blockchain, but privacy sector, the one that who deal that try to manage your private keys, like they for some reason they didn't do well. I don't know why. Right? But actually relatively low correlations will say across different say sectors, right? Say centralized finance was little correlated with Web3 infra, so stuff like that. So I think really the mindset, if you want to apply say trend following models or some sort of factor models, it's really the way to go is doing some clustering, some sector or statistical.
Yeah, I think we just take for granted that the clusters have been defined for us in equities markets and in the commodities space, whether you've got your Barra factors or whatever clustering. Now, because of the emerging nature of cryptos, you're going to have to do that yourself, and it does take a lot more legwork. But probably the value for creating clusters is a lot higher again because it's not commoditized. I always feel like the harder it is to get the data, the harder it is to get to the answer, the more alpha there probably is, because once it's commoditized, it's easier. I do believe that, what Arthur was saying is you can do this combination of the fundamental side, and you could do the statistical side, or you could do some combination of both. I have tried all three of those. And it does help you because it not only develops your intuitive understanding of what's going on, you get your hands dirty in the space, and you will also be able to see how things are changing and how fast things can change in a relatively new environment. So, maybe it's something to think about.
And it seems like you're suggesting that it's not just a statistical um, problem. You just don't feed price data to a clustering algorithm like you would do for financial instruments and derive your clusters. And from there, you're trying to infer some sort of linkage between the clusters. You need to do a lot more than just observe price and let the computer allocate to different clusters.
I will not confirm nor deny that statement, Bruno. Okay, maybe that's kind of a dicky answer. You could feed it only price data. You could look at Granger causality as in a league lag framework. You can look at say Pearson correlations, Spearman, sorry, instead of Pearson, to try to get rid of some of that linear assumptions because you go to rank correlation. I mean, it just depends on how fast the reaction is and how good your clustering needs to be, right? So it depends on what your how sensitive that output function is going to be that you're using this correlation matrix as an input. And again, this is kind of where machine learning comes to the rescue, or a Bayesian approach comes to the rescue, or even a PCA based approach comes to the rescue. Those all things will give you additional boost over a straight 30-day Pearson correlation and all of those could only be done using price. If you want to go the extra mile, you can do other sorts of things, but I think that's just the nature of the world.
Well, thanks. I mean, apart from your evil grin, that was a perfect answer the first time round. Thanks for clarifying it. But your compact first version answer was completely understood. So thanks. That's what I thought, by the way. I'm not doing. I mean, it's quite funny because perhaps one of the reasons why I failed is because I'm really constraining myself to Bitcoin, Ethereum, and another handful of major ones. But yeah, I think coming out of today, I will take a look at expand a bit more and going down the ranks. Probably not all the way down to shitcoins, but yeah, I think the useful one useful takeaway is to explore the universe a bit more.
No, I think that's why the problem is still so interesting. It's like all this is a very, very simple, basic problem. What commodities are in what sector? Okay, we have the grains, we have the oil seeds, we have the softs. Some might be, some might be tropical, some might be, whatever. We have like 6 different kinds of wheat, but it's known. We know. But because it's a new market, we get to decide. And in fact, how you decide is going to be different than how other people decide. That is, even if you're doing a fundamental, ground up approach, because how many different sectors are you going to create? If you go to CoinMarketCap and you go to CoinGecko, they both create sectors for you. They have totally different coins for something that you would guess is actually really similar definitions, just because of how different they are. And there are 2 major service providers. So if you go and do your own, it's definitely going to be different. And then there's some potential edge there if you're able to actually get better, more stable, more accurate, or however relationships. Eventually I do think that we'll all come to some kind of agreement that these are the 5 sectors that we majorly have, and you'll put that in your PowerPoint decks and ship it off to some clients or whatever. But when the work is here to be done now, I think that that's not only do we get to transfer more of our traditional finance knowledge because we've seen how it's built, but we can also do it slightly differently for ourselves, knowing what we know, suppose, and knowing that we can layer these models, we can do interesting things. You're not going to be like, okay, my PPM says that I only can trade Asia. Okay, whose definition of Asia? The UN's definition of Asia, the MSCI's definition of Asia. Even still in traditional markets, there's this differential. So all I'm saying is there's a lot of progress to be made, and if you do it well, there is opportunity.
Yes, I agree, fully agree. One thing that we didn't discuss and also very specific to crypto is uh, time series is so the data is very short. Okay, apart from Bitcoin, for Bitcoin also you have to count that 15, especially 17 was a year when it's generated plus more than 1000%, right? For most of the DeFi, especially DeFi NFT stuff, it really picked up last year, right? And so some bigger ones like Uniswap is only started late 2019 to 2020. So you have really 1 year of history, a little bit more than one year and 1.5 years. So it's also a challenge to test your models, right? And we had it's almost say if it started from say late 2020, it was only 1 year of bull market, right? Okay, now it's corrected a bit. You have maybe drawdowns of 50-60%, but this is also to like you don't have this kind of in managed futures, right? I personally I run backtests from 1960s, right? When the and it was data already like exchange based data, right? Say for most commodities. And of course, you can backfill, like even say equities, bonds, you can backfill. And you saw some publications, maybe 200 years of data, right? So here you don't have this flexibility, and then also you like you have to also think of it that it's extra additional challenge, additional dimension.
No, I think that that's great. The idea that we have short data and all of our models run on data, if you were trying to replicate a backtest for a CTA going even, to 1960s is impossible. And these coins, like Marcus was saying earlier, over 2 years, 5 years span, who's in the top 10, who's in the top 100 are changing. Okay, maybe if so many years ago there wasn't even 100, but this is where I really feel that synthetic data really helps because not only using proxies, to kind of fill that out, but also trying to generate different stochastic processes that have the characteristics that you want. Because this is something I learned or picked up rather, trading in mainland China again, or other emerging markets, because you have limited data set. I actually think that the data in crypto for an emerging market is pretty good, because it was fully electronic, and that's a great starting point. Yeah, it might not be exchange-based data, but at least you have something. But there's a lot of assumptions that go into building that, and that is something that I had focused on, not last year, but the year before. And I think I have to come back again with the kind of advances that I've seen in ML. I think that this is probably a very good place for ML to slip in, to create this type of dimensionality.
True, there is also simple like techniques like bootstrap methods that I find for me they're more say and there are smart ones that will preserve autocorrelation. Also, you can use it for say with certain adjustments for autoregressive processes like volumes, market cap. It's of course you can also generate maybe a mail base, but it's really I think the way to think it's really in distribution. We cannot take anything like we cannot just trust the path, one path. It's that have been realized. Right? We have to more like stay think in distribution. Mhm.
No, I agree with that. Bootstrap is a great place to start, but it's contingent on the distribution you already have, right? And yes, it can, if you're keeping the autocorrelation, you can slightly deviate away from the original distribution, but you'll be pretty close. And, if we believe the future is going to be different from the past, we're going to need to be able to try some more extreme distributions. And I think that that's really kind of the crux of it. Yes, we can create this infinite data that maintains some autocorrelation, or some, maybe we do some maintaining of a correlation matrix. But the part that bothers me really the most about just using the historical data is I want to have more tails sometimes. I want to shift the correlation matrix. I want to do those things, and then you just end up staging this stuff, and like, as opposed to having like one continuous thing. I don't know. I would like that to happen, not as like a block, but to like have it happen over time or something. That's not something I've been able to solve yet. Um, but I think I'm thinking along the same lines as you, Arthur, that we need to think about the distributions, like the true distribution that these processes are coming from, and then the covariance matrix between those processes, and then try to generate as much data as we can, either using the empirical data set as the best assumption, and then taking some tool set to modify those distributions or that correlation covariance matrix to see if we can put some extreme samples. I really have to pee.
But Plan B says that Bitcoin is co-integrated, so everything is easy, right? That was a joke. It was meant to be one.
Well, guys, it was a great talk. Arthur, thank you so much for your time. I appreciate always talking to you, and now that you're in the crypto space, talking to you more about crypto. Thank you for coming today. You lent incredible insight.
Thank you, Derek. And you do you do crypto on professional level or just on personal level?
Professional level.
Professional. Okay. And in Singapore, how's how's sentiment in Asian region for crypto and crypto investments?
I think Switzerland is eating our lunch. The issues with MAS clamping down on like even the advertising of crypto.com, which had been sandboxed, and they had ads on buses and stuff that has been killed. So
Wow.
even though they got authorized by MAS, you're not allowed to advertise to retail, even though they got sandboxed for retail. So I think Singapore is having a bit of an identity crisis with that. Zug is definitely, I think, eating the lunch right now, just because Europe is open. So the company that I work for also have presence in Switzerland, so I'm easily able to see kind of what is happening in the Swiss side and what's happening in the Singapore side. Overall, sentiment wise of the people building, I think is quite good. I mean, I think that we have had some recent launches of some funds here. I do think that it's becoming, we're not getting clarity, but people are playing cleaner in anticipation of regulation. So that's overall a better thing. I don't see so many people doing kind of the gray zone tricks that they used to do. So I think that's a positive. But I really haven't seen as much flow from people exiting Hong Kong as I would have thought, which has kind of been a negative to me. They've really been moving to Dubai, Switzerland, things like that. So that's what I can tell you, Arthur.
Okay. Thanks. Thanks for insight. That was nice talking, guys.
All right. See you next time.
Okay.
Many thanks,
Cheers.
guys.
Thank you. Bye.